Welcome back to the channel. Today, we're unpacking one of the biggest paradoxes in today's global economy. Geopolitical tensions in the Middle East are rising. Exchange rates are volatile. Interest rates remain high. And yet the stock market is still climbing. So what's really going on? In this video, we'll break down insights from financial experts, the Federal Reserve's next possible move, and how global dynamics are reshaping the market. Let's get into it. Let's start with the Federal Reserve. Recent FOMC statements may sound cautious, but there's been a meaningful shift. For the first time, the Fed explicitly referenced tensions involving Iran. This isn't just geopolitical commentary, it's about inflation risk. Why does that matter? Because the Middle East sits at the center of global oil supply. Any disruption, especially in key routes like the Strait of Hormuz, can spike oil prices instantly. And when energy prices rise, inflation follows. We saw something similar during COVID, when supply chain disruptions changed everything. This could be another game-changing moment. Now let's talk about interest rates. Markets are divided. Some investors still expect a rate cut soon. Others are starting to worry about rates staying higher for longer. The Fed's position? They're not in a hurry. They've made it clear. They need solid, undeniable evidence that inflation is moving back to their 2% target. But here's the problem. If oil prices rise due to geopolitical conflict, inflation could remain sticky. That pushes rate cuts further into the future and reinforces a key narrative. Higher for longer is no longer a possibility, it's becoming reality. Looking ahead, leadership at the Fed could also shift. Jerome Powell's term is nearing its end, and attention is turning to possible successors, especially Kevin Warsh. Warsh has traditionally been seen as a hawk, favoring tighter policy. But recently, his stance appears more flexible. He's proposed something unconventional: cut interest rates, while simultaneously tightening liquidity through quantitative tightening. In simple terms, lower borrowing costs but reduce excess money in the system. It's a balancing act trying to support growth while controlling inflation. And it could represent a completely new approach to monetary policy. This isn't just a US story, it's global. Different countries are responding in very different ways. In South Korea, the Bank of Korea sees its current rate around 2.5% as neutral. Not too tight, not too loose. Meanwhile, in countries like Norway, central banks are still considering rate hikes. Why? Because inflation hasn't fully cooled. This divergence is creating instability in currency markets. We're seeing major movements in currencies like the Korean won, the Japanese yen against a strong US dollar. And that volatility affects everything from trade to investment flows. Now the big question: why is the stock market still going up? The answer lies in a major shift. We're moving from a narrative-driven market to an earnings-driven market. In the past, hype and future potential drove valuations. Today, it's about real profits. And one sector is leading the charge: semiconductors and AI. These companies aren't just promising growth, they're delivering it. Strong revenue, massive cash flow, record-breaking earnings. Investors are becoming more selective. They're moving away from speculation and focusing on companies that actually make money. As long as these tech giants keep performing, markets remain surprisingly resilient. So where does this leave us? We may be entering a new normal, a world where high interest rates persist, strong US dollar levels continue, and exchange rates remain elevated. For example, levels like 1,400 Korean won per US dollar may no longer be temporary. But there are also stabilizing forces. South Korea's inclusion in the world, government bond index could attract global capital, and AI-driven growth continues to support equity markets. So how should you navigate this? Focus on companies with strong cash flow. Watch geopolitical developments closely, and stay adaptable in a rapidly changing environment. Thanks for watching, and we'll see you in the next one.